Welcome everybody to our long verticals and diagonals webcast. I'm Connie Hill. Happy you have joined me here today. You know, we only focus on these two strategies. And a lot of times they can involve a little bit of time. Today we're going to focus on diagonals. And the thing I want you to know is maybe in the past we've done some non-traditional diagonals. And today we're going to be focusing on maybe something that's a little bit more typical in terms of a shorter term diagonal, although we can use them a lot of different ways. All right, so stay tuned. We've got a lot to cover here today as we look at some previous diagonals as well. Now, I am joined in the chat by Scott Thompson. You guys know Scott, veteran of the markets, and he's here to maybe help me with some questions I can't quite get to. So as you have those, go ahead, chat them in. Scott and I will be watching the chat to make sure we pick up all the questions that we can. Now, hope you're following us on X. I'm Connie Hill CS, Scott is Scott Thompson CS, and we'll post educational content out in our X account as we happen to view and see different opportunities or things we think are interesting. We'll post about them so that you can be seeing that as well. Let's go through our disclosures and get down to business. What we talk about today is intended for educational and informational purposes only. Don't consider a recommendation. We'll be using technical analysis here today, but keep in mind Schwab does not recommend the use of technical analysis only as your sole means of research. We will be using the Paper Money software application. It's a great educational tool, and I tell you, if you practice in your Paper Money account these strategies, it'll help you with your comfort level with them. One distinction between the Paper Money and using Thinkorswim in your live account is in Paper Money, it will not assign short options early, but you need to know that short options can be assigned early, even though it won't mimic that in your paper account. Past performance is no guarantee of future results. We talk a little bit about the term rolling in this class, rolling a particular trade, and simply that just means that we're extending the trade, but just doing it on one ticket, closing out one leg and selling another. Just know you'll be assigned commissions for every leg you trade, getting in, getting out, so forth. And investing involves risk, including the loss of principal. All right, today we're going to just talk a little bit about the components of diagonals and long verticals because they're similar in some ways, but they definitely are different. And throughout, we're going to talk about the impact of price, time, and volatility, as those are the main things that impact an options price. And we're going to be looking at a lot of different example trades here. All right, Sam's got his Paper Money up and running. Excellent. Those considerations, you know, with price, generally that's going to be the biggest thing that determines an outcome of a trade, right? We need the stock to move and move big, or if we need it to move small, not move a lot, that's definitely going to impact what's going on with our option. All options are subject to time decay. Now, in these two strategies, we have a long leg and a short leg. And so they can help impact the effect that we feel from time decay and volatility. Typically, if volatility is going up, that will increase the price of our longer dated option, which is typically our long leg. So that can be useful, but it doesn't necessarily always drop. Sometimes it might. Volatility going up expands the price of your long leg. I think I may have said that backwards. And so that can be helpful for a long vertical or a long diagonal if that implied volatility is going up a little bit, but doesn't always work that way, as you know. So we just want to be aware of all of those types of scenarios. Now let's go through. A big part of our class is examining previous trades and doing some analysis and making decisions and talking about those decisions. Let's go ahead and move into that portion before we get into any new trades here today. Going to come over here to our Paper Money. SPX looks like it might actually, I guess it is down just a little bit, 0.16% at the moment. On the NASDAQ, it's down a little bit more. We can see a little bit of a gap down here. Looks like it's kind of stabilizing. We'll see what happens the rest of the day, but it's currently down about 1%. What would we expect the volatility to be doing if we look at the VIX? We might expect it to have gone up a little bit, and it looks like it did, but it looks like that is fading, right? We see that long shadow there to the top side of the candle. So the VIX popped up a little bit higher, maybe around 1650-ish or so, and now is pulling back a little. So maybe we had markets off a little bit more today than what they are right now. Now, in the left-hand side, I have our watch list that we work from. It's called Liquid Options, and we'll refresh this watch list from time to time. I do it maybe about every 4 to 6 weeks. This one was done on, let's see here. Drop down to, well, I guess it's going to be here. Maybe it's going to be in here. Here we go. Liquid Options, and the most recent one we did, and this is the list we're working off of, was June 11th. So we might be needing to update this. We won't be updating it today, but this is the list of stocks that we're using. So if you're wondering, well, what was that scan that we used to put together that list? Go back to that June 11th class. If you're a subscriber in our Trader Talks channel, you can go back there, pull up the watch list. In fact, Scott has pasted the watch list, a link to it out in the chat, so you can go back, you could find that class June 11th and see how we did that. All right, let's see here. Let's take a look at the monitor tab, and let's come over here to our open positions. Now you can see we have 4 of them open. 2 of them were long verticals from last week, and 2 of them are some ongoing diagonals that we've been using for a long period of time, and we'll continue to extend those trades as long as they're working for us, okay? What happened last week with a couple of long verticals that were in? Well, one did pretty good for us, and the other one did not. So we're going to start with the one that didn't do as well for us. That was Texas Instruments, TXN. Now, Texas Instruments, you can see we got in on this green oval day. So that was the 18th of June. And we had a long vertical going on it. So we needed it to move up for us. And it really didn't. It kind of pulled back, and it had signs of bouncing back up and signs of bouncing up, and it never really went that far. Last week in our class, I told you we will probably be closing this trade out. If it wasn't later that day, then we were going to do it Friday. So our class was on the 9th. This candle I'm on is what things look like on Friday the 10th. It'll look like, oh, maybe we're going to have a positive bounce here. Maybe we could find a little bit better exit point, was the idea. Not necessarily thinking, hey, we're going to be able to turn this trade around. That was not the case. However, it was having such a good day Friday, I thought, let's extend it to Monday. Let's just go one more day on it. Well, that was not a good idea because I was out of commission on Monday and Tuesday, and look what happened. It actually pulled back quite a bit. So I did not follow what I told you I was going to do. And as a result of that, we've had a worse position exiting. We finally got out yesterday, and you can see another long, big candle, red candle here. Fortunately, we're not still in it with the gap down, but we are taking a loss on that. How much of a loss? I will show you. We paid $5 for that spread that we got into. We were hoping to make $5 or a percentage of $5 as our max theoretical gain. Instead, we ended up closing out at $1.51, so we lost $3.49 a trade, and we had 4 contracts on. So that was a loss of about $1,396. So just shy of $1,400. Had we exited on Thursday, like I told you we were going to, or on Friday, it would not have been nearly as bad. It would have been a more kind of a smaller loss. We still would have had a loss, but not nearly to the extent. So lesson from that is when you say you're going to get out, go ahead and get out. Okay. Yeah, sometimes it might go better in your favor, but that's not always the case. All right. So let's talk about the one that did nicely for us. All right. Let's take a look at Apple. Now, on Apple, we had done a bearish trade on it. When it broke the support, we were out of that trade immediately. Okay. When it turned the corner, went back above that resistance and had just kind of this nice pop, that's when we got into it. So this trade was going for a couple of weeks for us. We ended up getting out yesterday. Now, I have to tell you, earlier in the day, we were up on the trade about $1,100. I went and I checked our working orders. I was like, it's not quite to where we had said we wanted to get out. But I was tempted to get out, but I didn't. I thought, it's having a nice day. I think at the time I looked at it, maybe we were about, maybe about half of this candle that it put in yesterday. And so the thought was, well, if it's having this recent momentum, that momentum might continue. Let's just leave it alone. Okay, so we left it alone. And towards the end of the day, it went up and hit our order that was sitting in there. So let's make sure we're looking at the right one here. So it's this trade right here. We got in for 475 and it went up. It hit, I don't remember what our percent was. I'm thinking it was about 70% of our max gain is what we put in for our target. So later in the day, this looks like, okay, about 10 o'clock my time, which is mountain time, is when it went ahead and hit our target for us. We got out at 840. That's what we were hoping to get filled out. We said, if we can get out at 840 or better, great. So in this case, we ended up with 840 is what we took out as of the potential gain. It cost us 475 to get into the trade. So 365 per contract is what we gained on that. Times 4 contracts, we ended up on that trade about 1460. So 1100 wouldn't have been bad to get out at, right? But we did let it roll, ran up here to our target, and we're out easily in plenty of time. These options don't expire till the 31st of July. Okay, that's what happened with those. Dale says, in our market, maybe it's not a bad idea to just take it. Yeah, that sometimes can be the case, especially if maybe you're up near your target, or maybe the stock's running up near resistance. Yeah, then definitely, then that's a time to think, maybe it might be time to override that. Just because of the logical and what you're seeing technically, not necessarily for an emotional response, right? We don't want to trade emotionally there. All right. Next up, let's take a look at our ongoing diagonals. Come back here to our positions. All right. Let's start with a sort of traditional diagonal. That'll be Cisco here. Cisco, due to your request, some of you in our group wanted to do something that was a leaps contract, wanted to buy something with a lot of time and have us use this strategy as long as the trend stays in there using a really longer dated option. So we did, we went out and we bought a June 27 that expires in 2027. Okay, so we've got almost 11 months on this still. Okay, so we have lots of time here. The value of this option has decayed quite a bit. It was an expensive option, 2025. It's down to about $14. However, the rationale here is that we are going to sell calls against it. And those calls, the accumulation of those calls should help lower our net debit on the initial trade getting in. We got in this trade on June 18th. So each week since June 18th, we've been selling a call, selling a call, selling a call. Typically, we're going to roll it in our class. We've been typically doing it on the weekly Friday. So last week we sold the 121 call, brought in $1.69. If we want to go close that trade out, man, we've got most of it out of there, don't we? Yeah, it's down to 1.5 pennies. So yeah, we've been able to milk that one. It only has 1 day, and so we're going to stick with our plan. We're going to roll, okay? Which just means buying back this short leg and selling another one. Well, let's go figure out what we want to sell. Go over here to the trade tab. That should be Cisco there. Let's bring up our Cisco. Get rid of that. So we want to roll from the one expires tomorrow to the next week. That's going to be July 24th. And you got to determine how aggressive or conservative you want to be in this. You know, if you want to say, I want something that'll expire with a high probability, you might go a little further out of the money. Look for a 30-something delta. Some of you might even look for a 20-something delta. Some of you might even be a little more aggressive and sell a 40-something delta. Now, I want you to look at what the chart is doing right now, because that could make a difference in what we decide. You might be looking at this and go, man, Connie, it looks like maybe yesterday this bearish candle closed lower than our support level. It did. And it continued on today. It has a nice gap down. So some of you might be thinking, do we need to get out of this trade? I thought it, this morning, that was a definite thought. Ooh, do we need to get out of this trade? The purple line here is a 50-period moving average. So the red is a 30, blue is 10. So this purple 50-day moving average, yeah, it closed below it yesterday. Now let's take a look at the long-term trend. If we're planning to be in this for a long period of time, like up to a year, we wanted to make sure we were doing something that was quite bullish, and we are, right? That trend of Cisco is quite bullish. Let's come back here to where we are right now. Let's talk about gaps. This stock gapped up on some apparently some good earnings news, right? Had the gap up here, and usually the bottom of the gap acts as support. And it did for a long, long time up until the last couple of days. Now, if a gap stays at that support level here, like this one has, but then breaks over it, how far do we think it might fall? Well, it could fall to fill in the gap. If that were the case, that would maybe put it down at 102. Right now it's at 107. That's another $5 drop. In this case, what I'm seeing here is that we do have lower lows and lower highs in the trend, right? We peaked up there at 130. It has a lower high, lower low, lower high, and again, more lower lows. So this thing is kind of turned the corner on us. Now, if it were hanging as support, if it were looking like maybe it could bounce here, we might be a little bit more patient with it, okay? Since it's not in its reversing trend, we're going to go ahead and close out of it. I haven't tallied all the numbers to see how many calls we were able to sell against it. I know we rolled here, we rolled here. Actually, that was our initial entry day, was the 16th, but it's looking weaker on us. So even though we have that longer dated option, I don't want you to necessarily think, oh, we've got plenty of time, even though we do have plenty of time. But seeing the trend reversal is if we were in a stock position and that were the criteria to get out, we would follow that through to the long call as well, especially these longer dated calls. So I hate to do it, but we're going to close up this trade. We don't have anything in there as far as any working order, so let's just go ahead. We want to make sure we're closing out this short leg as well. So typically what we'll do is we'll get rid of the short leg first. Let's see if it'll fill us at 2 cents here. If not, I'll come back and change it. And then we're going to go ahead and sell the long leg. Well, we might need to get out at that natural price then. Let's go ahead. Let's get our extra, give it an extra penny. That should let us close it out. And then we'll want to close down this long leg, noting that we're going to be taking a bit of a loss on it, pretty decent size loss. However, we don't want it to get even bigger. Okay, so we're going to create our closing arrow order there. Our short leg hasn't closed yet. I'd really like to see that short leg close. Let's, maybe we need to give it even more than what it wants. Let's see here. We're giving it the natural price. Let's come up to a nickel, see if we can get out for a nickel. Generally, it usually takes those. Okay. If the short leg isn't closed, we still are at risk potentially for that. Now, it's not really likely that this price, let's see, it's probably not really showing. 121 call, the stock's at 107. It's not likely to go racing up to 121 in the next days, but you do want to minimize your risk there. So I will do this. I'll go ahead and submit our long leg too, but I want to make sure that it really closes up. Looks like maybe I lost that order. So let's come back here. Let's just close it up once again, create our closing order, see if we can get something close to the midpoint price and send it in. When we're talking about how far it might drop, Paul says, yeah, it's at 50% of the gap where it had fallen to right now. Kevin says 50% of the fib of the gap is about 108.72, which we were definitely lower than that at 107 and some change. Yeah. Sam notices we didn't have this technical indicator up at the on balance volume. Sam was showing that we're seeing a lot more pressure there. In any case, I'm seeing if there are any other questions on that. Looks like we've kind of all on the same page of that. Sam says the stock's down 3.7%, so we might want to pause on the roll and wait for a better premium. We could, but it's met our condition of when we would want to be out of the stock, so we're going to go ahead and get out. All right. Next up, that was our Cisco. Next, we have our longer dated non-traditional diagonal. And why is this non-traditional here? This particular diagonal, this is a put diagonal, and typically we would be bearish on a put diagonal. Just like on Cisco, it's a call diagonal and we're bullish with it. However, on this one, it's a little bit different in that the idea with this trade is that all we want to do actually is sell puts. We want to sell put, sell put, sell put. And this longer dated put option is our hedge leg. It makes it so that we don't tie up so much money out in our account so that we can continue to sell put, sell put, sell put. So we've been doing this for a long time. Last week, our longer dated put was so far out of the money, it wasn't really giving us the kind of protection that we needed. So we went ahead, we stayed in the same month of August, but I think it was like at a 250 put, we went ahead and rolled it to 310. Now on our short leg, again, we did this last week as well. We sold it for $8.95, which is great. We can go buy it back now for 30 cents. So have we got the majority of this? Absolutely. We've got 90% plus. We've got 36 more days on our longer dated option here. So what are we going to do? We're going to go to July 24. We're going to pick an option to sell. I want to look at the chart here as well. And W. This is when we initially got in the trade, bouncing off the 10. You can see how well it's run up. So we've had several rolls each week, buying back our short put, selling a new one. Right now, it's run up nicely for us. What is it doing right here, right now? Could it be running into resistance? Yeah, it could be running into some short-term resistance there. We could draw a line there that might make sense, right? So it might stall out on us. Which it would be nicer if the stock were actually going up, so the put that we sell would be decaying, but it could just go sideways on us for a little bit. Okay, we don't know. We'll have to see. Let's go pick which one we want to roll to. So we want the July 24th. We're going to be on the put side because it's non-traditional. And you get to decide how aggressive you might want to sell. If you want to sell a 40-something delta, if you want to sell a 30 or even a 20 delta, you can decide. Somebody that's really aggressive might sell up here around, a 40 delta. Now, if the stock were in a bullish position and looking like maybe it was going to bounce, we might consider being more aggressive and trying to bring in a bigger premium. But because it's kind of sitting at resistance, might just go sideways, we're going to go out of the money maybe a little bit more. Stock's at 356. We're going to go out here to 345. Okay. The other thing with these, even though this option is, or the stock is pretty liquid with a lot of the options, here there's not a ton of liquidity out here in the open interest of every strike. And so for that reason, we need to be a little bit careful too. So this one only has 52 contracts, but that's better than 9 contracts or 10. If you're really quite concerned, you might go out to the one that has 71 contracts. I'm okay with the 52, so we're going to sell the 345. Okay, back to our monitor tab, back to our short put. We're going to create a rolling order, which all that means is closing down one, selling the next one. So right here, buying back our 325, and then it doesn't know what we decided to sell. We said 345, right? So we're going to sell the 345, July 24th expiration. We're still going to have we should have a decent credit on this, right? Because we're buying the other one back for peanuts, just a few cents. So yeah, we're still bringing in a decent credit there. And remember, our strategy here is not so much that we're bearish, even though it's a put. Our strategy here is that we're actually bullish, and I don't want to say it's disguised as a diagonal, in as much it's more that long leg on the diagonal is more acting as a hedge, so we can sell. Okay. Oh, let's go ahead. Let's roll this. Yeah, let's see if we can get it for that. All right, looks like it filled us at 707. Now, usually we have some questions on this particular one. Yeah, Chris says that's kind of close to a tweezer top on that. KH Hangamila, you had some great questions in the comment section out in YouTube. Appreciate those questions because they really, I could tell you're really thinking about this strategy. Do you keep rolling up possibly if PANW keeps rising? How do we manage as we approach expiration? As we approach expiration, maybe not next week, but the week after, if it's still going well, and maybe we've got, say, 3 or 4 weeks before the option expires. If we still like it, if it's still performing for us, then we're going to end up buying a longer dated position, not August. We might come out here to say maybe October. We might buy something with about 3 months worth of time, roll it to October, and then continue to do it. Sell puts, sell puts, sell puts, as long as it's bullish. Okay, that's going to be our strategy here. Okay, so as we get closer to options expiration, we're not going to run it to expiration, right? If we're in a couple of weeks here, that's going to be about 24 days out. So maybe next week or the week after, we would want to roll it if it's still doing well. Great question. How does this act as a hedge on PANW if you don't own the stock? Well, when you sell a put, there's a certain amount of margin that's required to do it, because we could potentially be put that stock at $356, right? That's a lot of cash to tie up. Now, we wouldn't necessarily, depending on what kind of account you're in, you might not have to have the entire amount tied up in margin. It might be a portion of it, but it still could be a big chunk of money. And so what that long leg does is gives us that protection, because it is a, let's see here, 325. No, it's a 310. Okay, so we have at least some protection at 310 in the event that maybe the stock might be put to us. Oh, we could substitute our 310. Okay, have the opportunity to put it to somebody else at 310. Okay, so that's kind of how it acts as a hedge. Any concern with the spreads? A little bit there, Alfred. That was something I noticed as well, is that the spreads in the monthlies, and this is pretty common, isn't sometimes as good as it is in the monthlies. Now this stock, it's early in the day, it's traded 1.6 million in volume. And it does a pretty decent volume, generally speaking. So yeah, that the spread could be somewhat of a concern, but we're trying to do most things at the midpoint price. If it gets filled at the midpoint price, then we're in a much better situation. Okay. Very good. Good questions, you guys. I love that. Now, if I missed your question, chat it into me again. I went up, looked at some of those questions. I think we're in good shape on them, but if not, let me know. We'll come back. Now, I told you that, yeah, Sam thinks maybe the 33 delta on the 310 put. Yeah, it is out of the money a little bit on the 310 right now. Actually, yeah, it is out there a little bit more. We were quite a bit more closer to the money when we actually rolled that last week. Okay. Now, I promised you we'd do some diagonals today, and I'm going to take the approach that they're a little bit more traditional. Okay, so we had our PanW put diagonal that we're trading bullishly. We had our Cisco using a leap, which is starting to reverse on us. So we're going to minimize our loss. We're going to get out. The ones we're going to look at today, we're looking for a shorter type of move. Now, in our liquid options, both of the trades that we're going to do that are diagonals came from this list. First one we're going to look at here is, let's go take a look at the chart on this first. We're going to take a look at Merck Pharmaceutical. Whoa, it's having a nice bullish day here today, isn't it? Came down, tested the 30, doing a little bit of a ramp up. Candle wasn't nearly so big when I looked at it earlier. It was maybe half that amount, but that's showing us some good momentum going that direction. Now, initially, where might we expect it to go? Well, it looks like it's putting in some short-term resistance here around the 130. So a move from, say, 127 to 130 is not necessarily that big of a move. Now, the other thing I'm looking at here has to do with my scripts, 1 month return, 3 month return, to give us an idea, hey, has this thing been flying around on us, or has it been tamer, right? It has been tamer. You know, up 7% is nothing to sneeze at, right, over the last 3 months. But it gives us the idea that, okay, maybe right now it's moving a little bit, 10% in 1 month. But generally speaking, over maybe a little bit more measured period of time, it's not like it's up there 40, 50%, like some stocks might be, okay? Now, what we're going to do over here on Merck, come over here to the trade tab. And what we're going to do is we're going to go our longer dated leg. We're just going to make it be this August 21. And we're going to sell a July 24 again. So with the idea that we're hoping to also sell the ones on July 31, the ones on August 7, and possibly August 14. We're going to try to be able to sell. I want to put this trade together, and then we're going to use the risk profile to talk about it a little bit more. Now let's see if these strikes still look like they might work for us on the July 24th. I was looking at the 129. So our 129 call here. There's some decent open interest here. Actually, it's moved maybe a little bit more significantly. We might end up selling the 130 because that's at a 34 delta. In our August longer dated leg, we're looking to maybe go a little out of the money. Not a ton. This one I was looking at doing the 130, and I think that's still the appropriate one that we might want to do. The stock, for it to make it get up to say 135 would be really a pretty decent stretch. If we were buying out, instead of say August 21, if we were going out to September, maybe October, then we might want to have a further dated option because it would have more time to get there. I think we're okay looking at the 130 on this one. So let's go ahead. Now, if I sell the 130 here, this is going to be more of a calendar, which because we're using the same strike, I'll go out just a little bit more. We'll go to the 131. So I'm going to right mouse click, say buy diagonal. And so it's going to know we want to sell that 131. It doesn't know what we want to sell. It doesn't know our time frame. So it just goes out to the next period. We're going to choose August 21 and we're going to choose 130 here. So just a little bit out of the money. Let's look at this on the risk profile. We're going to say analyze trade. And it's got my leftover one in there from what I was doing earlier. Now, some of you may or may not be as familiar with the risk profile. Basically, it gives us a graphical representation of what option prices are likely to be. Oh, good. It just bought back our Cisco option. We're happy about that. Let's kind of maybe move this down here. The teal colored line here is the trade that we're looking at options expiration, showing us peak profitability right here at our short leg, which is 131. That's where peak profitability is. Now, this purple magenta colored line is our profit and loss as of a date down here. We need to bring that actually to the current date. It's sitting at July 10th. Today's the 16th, so we'll move it to the 16th. And then up here, this date we want to be based on the expiration of the further dated option. Okay, so in this case, we're going to move it to August. And we're going to go to that Saturday after options expiration. And then we're going to say set slices to our break-even point. And it puts in this dotted vertical kind of gold colored line showing us where our break-even point is. So if the stock just moves a little bit, it'll kind of stay in this kind of a range where we can have some profitability. However, if it goes past the low break-even point, which looks like 126 and some change, or if it goes too high and goes to 136 and change, then we're getting into a position where it's not profitable. And that's why on this particular one, it's a little bit more typical of a diagonal because we're not looking for a very big move. So let's suppose right now it's saying, hey, if it, as of July 16th, if it was up here, maybe would be starting to make a little bit of money. We're not in the trade quite yet because we haven't submitted it, okay, but that would give us an idea that as time decays and say the stock stays maybe in a little bit of a range here, we're not going to plan on getting peak profitability. That's really hard to do, and that's at options expiration. Typically, we'll want to be out before that. So you might set a range with yourself. You might say, hey, if it goes between, say, 128 and 134, so maybe $2 off our break-even points, maybe that's a range you might be satisfied to sell. Get a little bit of a profit there, okay? Some of you, this is new to, some of you have said, I really like looking at the risk profile. It visually helps me kind of see how the trade can work out. Now, if you're not familiar with this tool, I'm going to encourage you to go to a class we teach called Getting Started with Thinkorswim. Cameron May teaches that class, and he does a really good job with it. And he'll take one session that is specifically on the risk profile, teach you kind of some of the in and outs in a little bit more detail than what I've done here today. Today, I've just kind of said some of the basics, okay? But we might use this risk profile to examine the trade as our trade is going on, okay? So our first example here is going to be Merck. Question here from Greg is, do we close before earnings? Earnings is here. Yeah, that's something we're gonna have to be aware of, is August 4th. We might close before then, just in the natural course of this trade. You might want a rule if you have a rule that says, hey, these kind of trades I don't want to do over earnings. It could have a big move up or down and get us out of that sweet spot area. So let's be out before they announce. And it looks like, I think these guys announce in the morning. Yeah, before the market opens on the 4th. So we'd want to be out on the 3rd. Okay, good question. Sam says, it is kind of a narrow window of opportunity. It is. It is. We're not expecting a big move. Having it have some resistance up here about 130, that's kind of ideal for us in that's where our short leg is, right? And that's where we're hoping the stock actually goes to. Maybe not tomorrow, but maybe a little bit over time, and we capture some time decay and get up to that area. All right. Thank you, Scott, for posting in the playlist and the webcast specifically on the Analyze tab. Man, Scott is good, isn't he? He is good getting some of these great links in here for you. All right, you guys. We're going to do one more kind of in a pretty quick order. I think I sent this in. Did I not send it in? I don't think I did send it in. Let's go ahead, confirm and send. Midpoint price still. Let's see if we can get filled at that. All right, second stock we're going to do. Again, this one is on our list. We're going to go to Altria Group. Now, Altria has kind of been stuck in this in this formation of a triangle. It has just kind of been bebopping around here. So would we be looking for a good big size move here? Not really. We'd be looking for it maybe to come up here to this 74-ish range. And you can see just it's making, for the most part, kind of some smaller moves. And so maybe just up a little bit is what might be ideal technically. On Merck, we're going to do the same thing. We're going to sell a July 24. Our long legs are going to be out in August. Now let's see if this still looks like it might work here. Yeah, in the August 21, I was looking about the 75 long option. That's about a 33 delta, so it has a little bit of room. So that's the one we're going to sell, is the 75. I'm just going to put a note over here, although that's hard to see because my ink color is not white there. Let me change it to white real quick or something. Okay, we'll go with blue. You can barely see that. All right, short leg. This is where we're going to start on the July 24s. I was looking here to maybe sell the 74. Let's see how that looks. We could sell the 74. We could even consider selling the 73. Let's go with our 74. We'll keep it as designed. It's not bringing in a ton of premium here. Let's get on the right one. Let's do buy diagonal. So we're going to sell the 74 and our long leg. It didn't really know it was 75, but it picked 75 because it's just the next strike in sequence. We're going to change that out to an August date. And this one's going to have a $1.08 debit on it. Again, if we look at it on the Analyze tab, this is kind of what it would look like. We'd want to go through, change the date here, set the slices to the break-even point so we have a look at that. Maybe move this leg out to the options expiration. We'll go out here to the 22nd. So we get an idea, and you're right, it is a small window. We're not looking at a very big window, the peak there being about 74. All right, my time is up. But if you want to get an idea of, okay, how could we do some shorter dated diagonals? I'm going to encourage you to paper trade it with me, right? These are just example trades. You'll do it out in your paper account. Then you'll have questions along the way that we can determine. When we get together, you might have a question about it, or you can write to me in YouTube in the comments section. Now, I hope you're a subscriber to our Trader Talks. That makes it easy to find the links that Scott sent out, as well as our different playlists, right? When you see or when you're subscribed, it just makes it a lot easier to find our content. So I'm going to encourage you to do that. If you're not following Scott and I on X, I'm going to encourage you to do that. Scott Thompson CS, Connie Hill CS. There was not a survey out here today, but if you found this helpful, go ahead, hit the like button on the way out. That'll let others know you found the content valuable. Now, coming up at the top of the hour is going to be Cameron May investing in dividend stocks. So we'll have a little bit of a break. We'll see y'all back here in about 15 minutes. We'll follow up on all these trades next week. We'll see you then. Have a good day. Bye-bye.